So first, let's talk about how we got here. How would we have come up with a name like Keyera? And that's been in another video, right? So we would have done, once you have an investment account, you have the option of screening or searching for, based on all sorts of different criteria, for particular types of companies. And so you would have had to do either a bottom-up or a top-down approach. Top-down being, let's look at the economy. Let's think about what's going to survive. What does everybody really need? And you might have stumbled upon burning natural gas in your furnaces or something like that, right? Or at least there'll be a little bit of energy required someday in the future, maybe not in the next month or two, but at some point in the future. And somebody has to transport and move that gas along, right? From station to station. And so you'd come up with a pipeline transporting company like Keyera. That's essentially how you start. And you'd probably get a few names of companies that are similar, doing similar things. And then you would start your analysis process. That would then take you to this part, right? This 5 or 6 step I made up the steps. The process is going to be similar, more involved, the more advanced you get, but it's a logical type of process. You start with calculating, you get the information, you calculate your statistics and ratios, and then you look at them and try and figure out if they're telling you anything. And if you find things that stand out, trace them to the source. So we you should have got to that point where you would have been able to produce these values, right? So plugging in these numbers from the annual report, which you could have got, always go to the source, always go to the actual reports produced by the company that are audited and released officially. Because if there's anything wrong in them, you can sue the company. So with those numbers, then we would have produced some of this information down below, right? So what I'm going to do now is complete that process, and we're going to talk about guidance. So guidance is something a lot of companies aren't giving now because of the uncertainty that's in the economy. But guidance generally means what the company thinks they're going to do in the next accounting period. So what will their revenue be? What will their earnings per share be? And it's a good guide because people love that the most, right? Because this is the most important thing up there, the revenue growth. Because if you're going to grow your wealth, you need to have steady profits, preferably growing profits, because cost cutting can only accomplish so much. You need to grow sales and grow profit. You need to grow profit, and to do that, you need to grow sales. So earnings and revenue growth are really one of the most important things, especially if what the company is saying they think will happen is even better than what currently just happened. So to get that, you can search a couple of sites. You can do a Google search. If you have your own investment account one day, all that information is provided. I provided on our syllabus right here, right? The earnings projections from compiled by TD Waterhouse from a whole bunch of different analysts. And if you want to know who they are, they're actually right on the company's website. Right here under the investor section, if you click analyst coverage, you'll actually see the 18 or 20 or so analysts and where they work. And there's even a contact phone number if you want to call and yell at them and ask them about why did you give this company a sell rating, right? So a pretty wide coverage for this company. So it's not exactly a small scale company, which is good because then you get a whole bunch of different opinions. And if they all are saying buy, which most of them are, you start to feel a lot more comfortable, but more on that later. So you would get to this process, where you have these numbers, and TD gave us this. So you had this. I said, don't worry about it too much. But one of the key things was that even the most pessimistic analyst, as of, when did I print this? This was end of April. Not that long before I made this video. So in the worst of the coronavirus pandemic, the most cynical analysts of those 20 or so were still saying profit each and every year for the next 4 years. So this is the current average of earnings per share. So the next year is $1.64 if you want to use the average. And you could do, I don't think I printed revenue. No, I didn't. That's okay. We'll just skip that just so you see how it works. And then you would go and you would put in guidance was $1.64. And that allows you to show revenue growth, or in this case, revenue decline. But if you look, revenue is expected to decline in the coming years, which is why the stock has been hammered, but then grow after that and recover, right? So that's how that works. If you put that guidance in, it gives you an idea. It's also useful earnings per share because valuation, price to earnings ratio, requires earnings per share. And if you want to do that properly, you want future earnings per share, right? You don't pay for what happened in the past. You pay, and you're going to benefit from what happens in the future in a company if you buy a stock and invest now in something, right? What happened in the past for a financial investment is irrelevant to you. It's not going to benefit or harm you. It's what comes in the future. So if $1.64 is the profit per share, you want to compare that going forward. If that's what's the average people think they're going to make per share, then you want to compare that to the stock price you would pay today if you were going to invest. Make sense? So then what would I see if I looked at these numbers? So the first thing you should do then is your first dry run through. What do you spot? So most important, revenue growth, bad news. However, the stock has already been pounded, so most of that bad news is already priced into the stock. And analysts seem to think you're going to make profit, and two, it's going to level out and recover over the next couple of years. Gross profit. So prior to the future, so as of right now, how does it look? What should stand out at you in these margins, right? As we move on to the next most important section. And in this file, I've created this checklist. And because there's a lot of different things to think about, you really need a checklist like this so that as you cover each one, you can sort of give a rating. And it doesn't have to be buy, hold, sell. That's common in the industry, but it could be like a 5-point rating where you think, I feel really good about revenue growth. Right now, you probably should say revenue growth is negative in the short run, but will recover in the future. And then as you go into margins, what do you say? And then it's almost like a rubric, right? And you look through it and what is the overall sentiment that you feel by the time you're done looking at everything. So if you look at what we have, the most important things we've said so far, for someone your age to be able to do an analysis, you should be able to do these things. And really, it's really good. First of all, this return on sales, this is for an industrial sort of company. That's pretty high. I mean, imagine if you invested in a savings account at your bank and you got a 12% rate of interest. Like that's good, right? Return on sales is what is your net income as a proportion of your total sales, right? If you're not familiar with these ratios, make sure you've got that ratio formula sheet open because you can't really interpret them unless you know what the formula is, right? So these are the same because there were no extraordinary things after the operating expenses. So operating income, final income, essentially the same. This, though, gross profit, that's telling you that they're either, because oil price has been falling for a while now, and their gross profit has been rising, which means they've been able to control costs pretty good, right? Consistently rising the last couple of years from 20% to 22 to almost 28%, which means the cost of providing what they're doing, not the operating cost, but the cost of the product and all that, right? Cost of sales, cost of revenue, cost of goods sold, has been falling as a percentage of total sales. They got that under control. Next, bit of a blip in 2018, but more than enough cash to cover the next 12 months of debt. So they passed that, and an improvement from the previous year. Debt ratio has been climbing. That's a bit worrisome. Is that because they're writing off assets, though? Is that because of write-downs, low of cost or market write-downs on their assets, or is there just borrowing? They're actually in a growth building phase if you read the management discussion and analysis. So that's not necessarily bad if things work out and they have bigger sales. But if you spend lots of money going into a big problem period of time, it could spell trouble. So that's getting a bit high. And then lastly, the price to earnings ratio for the last couple of years has been reasonable, but this is a very different time, so that's almost not important. You would then want to know what is it right now going forward with that up top. I should really show that whole thing, right? With the $1.64 of profit per share. Okay, once you've done that, what you want to actually do, this initial evaluation on the surface, that's what I would expect. But then from a grade 12 student who has learned a bit more about accounting, you'd want to be able to go now into the notes and get more information. But before that, let's do our surface run through. So if that's all good and we feel generally positive maybe about the future, the price of the stock seems to be right. To double check that, this was sort of the next thing I had you learn how to do was this sort of chart where you could look at a long-term trend of valuation, right? And see if it's come in line. And it's as cheap as it's ever been. So what are you paying for right now? Well, you're not paying for much profit, right? In that one previous video, we calculated that the equity per share, at least when I first introduced this company, the equity per share was more than the stock price per share. So you're essentially getting some equity for free plus all future profit, which every analyst seems to think they're going to make profit. So when you look at this long-term trend, now the valuation seems reasonable and the company seems reasonable, looks profitable, and 2 years out or so looks like it's going to do fairly well again, be back on the ball. So overall, it looks good, but you're not done yet. You have to do more in-depth analysis, right? And that's next. Okay, so then after a surface run through, what can you do? And that's some of the things, this is where you tie in some of the things you've learned in this course that are new. You would go, first of all, let's talk about this. If this is not enough detail, you can add more. And you can do a full run through, do all the common size analysis. It'd take you forever. Probably wouldn't add a lot of extra information, but you might want to do it. So understand that if you wanted to do that, all you have to do, anywhere in here, you can insert a row. Right here, for example, if you want to insert a row, it's going to say, hey, warning, but it'll work fine as long as you don't delete anything. Same here. If you want to insert a row, you can just go insert one left, and then you have more columns. And all of these formulas for all of them can just be copied to the right, right? And once you have values up top, they'll fill themselves in. So if you wanted to add accounts receivable, and you wanted to do accounts receivable turnover and you needed the account receivable number, you could plop that in. And down here, that which would go under cash flow, you could add the accounts receivable turnover, right? You could insert a row down there. You'd have to add the formula then for that new row, but you can make this as detailed as you want. You can manipulate it, right? So don't feel you're constrained by what this template has to start with. The next thing for another run through you'd want to do is what I asked you to do in that practice form. In other words, now that you know what account receivable methods there are for valuing bad debt, knowing what type of economic sort of situation you're in, you might go, all right, what if 20% of accounts receivable, we're not going to get it? Okay, so that was the first question. So first of all, one of the things you can do when you do more depth is you look at the notes and you use that knowledge to try and play with the numbers and see how bad they could get and decide if after that you still feel the same way about this firm and its performance. And then other things you can then do are look at external professional opinions, from some of those analysts, for example, about the firm, and we'll show you that after. So I asked you to do 5 things in that form. Let's do those real quick. So first, 20% of our bad debt goes away. Okay, so what happens then? 20% of our accounts receivable goes away. We never get it. So 20% of accounts receivable, if we look, here's our December 31st, we had 400 and we'll say 88 million or 89 million, $489 million. So if 20% of that is gone, how much is that? So we could quickly calculate that as a reduction in our sales. So in other words, we're not going to get it. It's going to become bad debt. So expenses will go up, and that would be an operating expense. Let's actually subtract. Let's do that right here. So I'll go turn that into an equals. Then we're going to subtract 0.2 times 488,500,000 was approximately what it was, right? So that it goes up. And then we can look at return on sales after that. Return on sales is, I didn't carry through. So I have to do that to both, right? So this income will be down by 0.2. 20% of 488,500,000 is what we'll say. And that has to be an equation, and boom. So now when I come down here, our return on sales has gone down. Question is by how much? Well, about 25%. But it's still almost 10%. 10% return on sales is still pretty good. How about that with a write down on our inventory? So what's our inventory? Our inventory, Inventory was about 93.7. So that's another, and we can go back and do the same thing again. So let's write down so which will be an expense. It's a non-cash expense. Both of these are a non-cash expense, by the way. We're going to then subtract 0.5 times 93. What was it? 93.7, we'll say. 93.7. And then I'm going to copy that because, as I've learned already, I have to do it twice. Okay. That takes us to a return on sales of 8%, only slightly worse than the previous year. Right? Largely because of this improvement in their cost of goods sold. So 8%, is that okay? They still make profit. Right? So if, in other words, what we've just done is if they have a 2020 just like 2019, or if we need to revise 2019, like is it catastrophic? Like all of a sudden, if you've noticed, they don't have much bad debt, and all of a sudden they have 20%, and half their inventory value goes away because of the crashing oil and gas prices, and they're still with an 8% profit margin. That's okay. It's not bad, right? They have room to absorb some of this kind of stuff, right? It's companies that are borderline that you should not be starting a long-term investment when they're in that situation. Okay, so what else can we do? What's the effect on the 12-month cash flow? I mean, for that, what you would have to do is you'd have to grab, you'd have to get the account receivable number, right? So everything above, so the quick assets here are going to change. So it's just the accounts receivable though, right? So if you go here, where did I put that? Right in here. Account receivable, 20%. We will subtract 20% of this number again, the account receivable at the end of the year value. That is going to reduce our quick assets. So we went from 176% of what we owe to 164% of what we owe in the next 12 months. Inventory has no effect because it's not a quick asset. Still in great shape. How about the debt ratio? Total assets would go down by, actually, let me just go up and grab both. So by this, so the value you write down inventory and accounts receivable is going to remove total asset value. I'm going to put an equal sign in front of that. And then our total debt ratio should go up to 60% from 59-ish and change. Again, not catastrophic. So these are the types of things that you would use your knowledge from the notes and otherwise to try to decide if, okay, our initial run through of the numbers they present to us, would we really change our opinion if we have a worst case scenario, right? And you change some of their decisions and see what the numbers do. And if they look about the same, then you can keep the same opinion. If they look a lot worse, then you know there's some bad things behind the scenes that maybe you should stay away, right? That's the general idea. Will this firm survive? Sure, you don't even need ratios for that. You can see what their debt. Look at current portion of all of their debts. They have these accounts payable, and they have ongoing long-term debt payments of maybe 200 million total. And look at how much their short-term assets easily cover that, and they have substantial profit and are expected to make profit. They'll be able to cover their long-term debt for a couple of years. It shouldn't be that bad at all. Plus, they also have, if you read more information, they have a line of credit of $1.5 billion, and they've only used 90 million. So they have emergency funds as well already in place. So once you do that in-depth analysis and you get that feel, there's still some other things you can do, right? One of the first things is, so the last thing is sort of the last question. So after these changes, what should the new stock price be if this was the worst case scenario? And analysts like to play around with that. Come up with they use more complicated math, but they'll come up with what should the target price be after we make these adjustments or after they factor in their worst case scenario. So let's go with this one. Down here bottom, this 15.7. So that's our multiple. So that's how much you're paying for $1 of profit a share, $15.70, 15.7 times that dollar. So I'm going to go to the checklist that I made, and over here on the side, I'll just do this quick calculation. So we have a multiple right now of 15.7. And the question said, if the multiple stays the same, So what investors are willing to pay for $1, profit stays the same, but the profit of the company falls. What should the stock price be? Okay, so if the current profit falls by, what just fall by? The easiest way to figure this out is the difference. I'm just going to grab this. Grab that formula, going with the checklist. Here's the profit after in total, because per share will be the same, right? Here it is without the subtractions. So if the profit fell by this, oh my goodness, this divided by this is 67% reduction in profit. Sorry, it's a 33% reduction in profit, right? So the current profit is 67% of the original profit before this worst case scenario stuff that we did. So if the multiple stays the same, then the stock should fall 33%. Okay, and then how would you use that? Well, if you really think that the worst case scenario is going to happen, you'd probably want to wait for a lower stock price. You think the stock will come in a bit, right? And that's if they keep the same multiple. Sometimes they might punish the company by not paying the same premium. So the multiple might come in and the profit falls. And that's where you use this. Like that could happen, but it would be a short run thing. That's what this thing is for. Look at the earnings per share. Look at where the stock has been. Look at a long run trend. What seems to be a reasonable price? Because remember, you're not going to buy, and if things don't work out for 3 months, you're going to sell. You're picking a good company for the long run. So if it's in a reasonable price zone, then you don't care if things don't work out for 3 or 4 months, unless something really dramatically changes about the story, about the economy, right? Changes the reason you believed in the firm in the first place. Then, yeah, maybe you do sell. Lastly, you want to look at some external analysts and some other information that can really enrich your understanding about the company. And one of the first places, I added some up here, right? So I did an earnings projection, which we've already used in this video. And then I added 2 others that I'll show you from the actual professional analysts. And they can really help you get insight into things that you yourself won't necessarily understand from the annual report, plus information that you might not be in the annual report, such as competitor information and stuff like that, and the analyst projections and that sort of thing. And they do this for a living, so hopefully they have a better understanding than you do. And unless you have millions of dollars in a firm, sometimes just reading analyst reports and doing the quick run through of these numbers, right, is enough once a year. So whenever a new analyst report comes out, skim it, see what it says. So we'll show you some of the things that are in them. Here's one from Morningstar. They usually give you up to 5 stars. So 5 stars means really good value, which we've already figured out, right? And then they have some dot jots, big reasons. Bulls, people who want to buy the stock say it's good. What they say down below, what the naysayers say, don't buy the stock, terrible industry, right? And here's so I'm not going to go through all of this. I'm just going to show you the types of things that will be in these analyst reports. So here's one, business strategy. What's the outlook of the company? The economic moat is the competitive advantage a company has to protect it, just like it's a reference to the moat around a medieval castle for protection, right? And the analyst says that this company has no moat, which means they don't have a big competitive advantage versus other businesses that do exactly what they're doing. And then some other things, what else? Some risk and uncertainty, things that could go wrong. And they've got some interesting stuff about stewardship, which means quality of management, because that won't appear in an annual report, because it's management that produces the annual report, right? So this is a solid evaluation of management. And there's other things too, right? Such as things about the industry itself, good summaries, just overall, and then lots of data. Just have to start to learn what it means, how to use some of it. There's actually definitions at the bottom about some of their terms and what their numbers mean, right? So stuff like that. So some of those things, and they're only a couple pages long versus an annual report that's like 100 pages long, right? And they give you, and often all of them just condense all of it into a single number. So either like 5 stars or 4 stars, or this one that with an 8 out of 10 maximum. right? So they get the big picture, but then they talk about individual components that come up with that overall score. And you can, add that to your sort of understanding and mix it with some salt and some other spices and decide what your final decision is. The very last source of information that you might want to check out would be something, again, from the company's website. Many companies will have presentation days. Often they'll have when they give their annual report or they give their reports, they'll have a presentation and they'll take questions from analysts, and they often will have a slideshow. And that slideshow often can be very straightforward blurbs of information that are important, that might be as much as you want to take in. So here's one. So Keyera had an investor day in 2019. They also have a current corporate profile, and there's a lot of overlap between the two. I've opened this current corporate profile. Here's what it looks like. It was made a matter of days before I produced this video, and I'll show you some of the things that you also, in addition to those analysts, some things that you might want to look at. Other analysts that look at companies are the ones that analyze the quality of their debt, because that's really important to bondholders, people that are owed their money back. The quality of the debt is a rating of risk, and those analysts also are very good at their job. They look at the industry, they look at the economy, they look at the company, they look at its management, and they look at the ability and likelihood that they are going to be able to pay back their bondholders and the people who have lent their money, their creditors. And they give a rating, and the ratings look at something like this. And there's different companies that do it. The Canadian one is the Dominion Bond Rating Service, the DBRS. And there's others in the States. You probably heard of them, maybe even, right? S&P, Standard & Poor's, same company that owns the S&P 500 index. There's also Moody's, Fitch. There's several. And the ratings are usually got a bunch of A's or a bunch of B's or C's. And the farther down the alphabet you go, the crappier the company, and the more risky that if you lend it money, you're not going to get it back. So as an investment, for someone that wants to own a bond and earn interest, once you're out of the B's, you're in a very speculative, it's called non-investment grade bonds or debt owed by a company. And if we get there in this course to the long-term debt section, because it's not in support as equity, so I'm going to leave it to the end, you'll learn a little bit about bonds and interest, but the degree that the greater the risk to the bondholder, the higher interest you have to pay in order to borrow money. So if you look here, it says right here, investment grade. Actually, I scooch a bit down farther. Where is it? Here it is, right? It says right there, triple B. It's pretty good. It's adequate. It's not super great. This is a high risk industry right now, right? But it's stable. It's good. Pretty good cash flow in this company. There's other things too. If you look at this, credit worthiness of customer base, that's important. That ties right into our receivables, right? Because they don't sell to people like you and me. They sell to companies like that you and me would get our natural gas from to run our furnace. So they're big companies that are buying this stuff from Keyera, right? And as you can see, how many of them are good quality? The only ones that are non-investment grade, there's only 22%. All of their companies either have secured debt or are adequate to superior quality risk rating. That's what they mean. Which means the likelihood is very small, only 20%. So if there's only 22% that are non-investment grade buyers, which would mean what we did when we said 20% of our receivables won't get paid, it would literally mean that entire section would not pay. So that 20%, even though it wasn't catastrophic, it's just very unlikely. Very unlikely, because the credit worthiness of all of their customers is pretty good, by and large, right? So things like that. There's a lot of stuff in here that if you don't understand, like you're not going to understand because it's a different industry, which, by the way, if you're putting a lot of money in a company, you better understand the company. That is a common sort of rule of advice that investment pros will give. If you don't understand, don't own it, right? Unless it's a really small part of your portfolio. But so yeah, there's a lot of stuff about the industry you don't understand. But you could zoom through these types of things and get information like this. That's pretty useful. It gives you some perspective you might not be able to catch in a great big 100-page long annual report. So that's a lot of info. So if you have questions, let me know. But those are some of the things I would look at. And again, critical, you need a checklist or something. Because by the time you're done, you will have forgotten what you were thinking with the first thing that you checked, right? Because there's a lot of different things you could look at. But remember, the most important are here. Check the revenue growth, check the margins, check out the trend in those. Is it been a constant, sustained trend? Check that cash flow for safety in the near term, especially in economically uncertain times, right? And then once you have that baseline, you can start to look for other analysts' opinion, other professionals' opinion, and other little tidbits of info. All right. So that's it. Good luck. Try it yourself. Watch a stock for the rest of the semester. If you have any questions, let me know.